Another week, another installment, talking about the state of the economy and what has been transpiring over the last few days as Jerome Powell has testified in front of basically all of Congress and has, shed some light. More recently was actually the report released yesterday at 10 a.m., which shed a lot of light on what I've been talking about for the last few weeks, which is, and also I will talk today also about the Bank of Canada doing a rate hold, which was a horrible, horrible decision for, I know a lot of people are celebrating in Canada, like, hey, they're pausing, they're keeping bank prime at 6.70%, like just under 7%. That's awesome. But it's actually not. It's really horrible for the currency, and it's going to cause massive currency destabilization between Canada and other countries. So if you have Canadian dollars, it's going to suck. But let's talk about what the Fed has been up to. And by the way, guys, I'm on the road a little bit here, so apologies for that. Literally, that's the water park right there. Got a free upgrade to a sweet balcony suite. There's a big water park out there. The kids are all out there. There's a big bucket, dumps water and water slides, and got this room for $53 for the night. So that was a super score, in line with my frugal quality living. Because I'm all about trying to, maximize life experience without having to pay for that, right? I want to live like I spend 200 grand a year, but spend 30, 40 grand a year. Anyway, so back to the State of the Union, state of the market. If you guys have any questions, jump down below. I'm gonna keep this stream about 45 minutes in length today. Hopefully the internet's okay. Hopefully the Marriott Courtyard is, obviously providing some quality internet tonight. Fingers crossed. I'm a platinum member, so usually they give me a little bit of an upgraded speed tonight, but again, it's a big hotel, so I don't know where we are relative to the Wi-Fi, modems and routers and that. So I have the door cracked a bit. If there's a lot of static feedback from the water park, I can go close the door. Just let me know if you guys can hear or if that's picking up or not. I was literally just in the water, so forgive my little ponytail I got in right now. It's a bit unprofessional of me, but my hair is just so crazy right now, and I'm living life. I'm enjoying the surfer dude vibe, and I'm like, I'm not gonna cut it. I'm just gonna pin it up and keep going. So here we are. Let's talk about the State of the Union. The last week, so what happened on Monday? So Monday, stocks are starting to fall back into a free fall. Last Thursday, the NASDAQ had 280, the QQQ was at 288, and it rallied to over 304. From Thursday, there was a reversal from Thursday all the way to Monday, where we had like almost a 5% rev up in the index, and that seemed to crash back down yesterday. We don't really care about the movement because we know that we're going to keep buying the dips, and over the long term, if you buy a little piece of every stock in the whole index, you always win, right? So that's the advice I have for everyone watching this. So like, how do I time the market? I'm like, don't time the market. The secret is to slowly buy in the dips and hold. If you're short, I've been shorting, don't do as I do. I use my shorting portfolio as a small percentage of my entire portfolio and a small percentage of my overall net worth, and I play in there and I hedge. So if my real estate portfolio gets crushed by raising interest rates, which possible, or the fact that real estate continues to fall and the currency falls a bit, you can use short trades to hedge against that. So it can protect, what you see is that as the market falls, the US dollar gains strength, right? So as the economy goes to shit, the US dollar is the world reserve currency, gets more and more strong. And as the US hikes rates, which they continue to do, I've been saying this on this channel for a year now, we are not going to have a U-turn where rates are coming down in 2023. It's not happening. People were saying, hey, like by May or June or July, we're gonna have rates start coming down. By 2024, it's back to normal. I'm like, in 2024, we're gonna be at the peak rate. Oh, well, hopefully we're at the peak rate, and then we're coming down, hopefully into 2025. So it's looking like it'll be 2022 to 2025. So a 3-year period of pain. And the bottom of real estate will fall after the U-turn pivot. After rates come down, it takes many months after that for prices to catch up. Real estate lags. Talk about this. When you sell a property, it's typically 120 days before you actually close. It's not very liquid. You can't, like you sell a stock and in 1 or 2 business days, you got cash, right? It has 1 or 2 settling days, you get cash into your account. Not the same way with real estate. You're months to get cash, right? So that's something to think about and think through when you're planning whatever your next move is. Like, just remember that if you're 100% real estate, liquidity is going to be a challenge for you. And becoming liquid, in some cases, if you are trying to max out your property's resale value, you may sell on the market in this economy where we are right now for 2 months until you get the price that you want potentially. And then it might be someone comes along with a 4-month closing. They're trying to sell their other house, they want 4 months. That's standard. 90 days, 120 days. And then something happens during escrow and all of a sudden it delays even further. And it can be a 6-month process. Like by the time you spend a month getting your property ready for resale, you got to, clean up the property, get the tenants to all clean up any repairs or stuff before you put it on market. You got to do all that kind of stuff, right? Get your property just tip top shape, and then you can bring it to market. So you're talking a month or two already in. If from the moment you decide, probably you're a few weeks just getting trades lined up and getting everything cleaned up. And it seems to be that takes about 6 months to get liquid. So what we see is that then after that point, it takes another few months before realtors start and appraisers use comparable sales to justify the new prices. So once prices start to uptick, and because we'll see a bit of a wavering downward pressure. I think in Ontario, at least, most of the pressure's already happened. Like we've dropped 30% in most of the southwestern Ontario markets, from Toronto, Oshawa, London, Ontario, Sarnia. Most of the markets are down that I follow. Pretty much every market's down about 25, 30%. On top of that, the US dollar to Canadian dollar was trading at, you could effectively give $1 and get $1.21 Canadian. It now buys you $1.38.5. The Fed raised rates and continues to raise rates to fight inflation. They're serious about it. In Canada, we have a real problem, and we're the number one most indebted per capita towards real estate than any other country in the world on average. Canada has the most debt per person towards real estate of any other country in the world. So we are very acutely in pain during times like this. And because Toronto, Vancouver, a lot of our major markets, every house is over $1 million, people have relied on mortgage debt to, finance their lifestyle effectively and get into the house that they otherwise wouldn't be able to get into. And so it's a real challenge in Canada. And that's part of why the Fed they've kept their word and they've held the rates. They did the last 25 basis point hike. Now they've held. I foresee more rate hikes coming. It's very likely that when they held, if you look at the last 48 hours, the currency to the USD dollar, the Canadian dollar, has lost 2%. That's a huge move in like 2 days, to lose 2%. And over the last year, it was $1.21 at the low of last year, and it's now $1.38.7. So we're talking about almost $1.40 to $1.20. That's almost a 20% shift. And I used this example on my Instagram stories yesterday to people messaging me being like, well, is this now a good time for a U.S. investor to invest in Canada? And I'm like, potentially, yeah. Look, we're one a year ago. Let's say you've taken $10 million or $1 million for simplicity. You took $1 million American and you invested in in Ontario, Canada, Toronto. And you used some leverage, you took that $1 million and you bought $2 million in property, meaning you put 50% cash, 50% mortgage. If you're following my example, I guess actually there'd be $1 million US would buy you back then like 1.2 something Canadian. So you have let's round up and say 1.25 million Canadian. You would have lost some in exchange. Even if you went through a broker, don't go through your bank ever to exchange currency. Never. Even like companies like Knightsbridge are better than your foreign exchange type offices, but you can literally go on Interactive Brokers and you can trade at spot with just a trading fee. Or you can call up Monex or other guys in the Goldman Sachs floors. They'll trade for you at spot price. The bank adds 3% markup to that as well. So right now, if you go in, the currency's 138, they'll charge you $1.41. So you'll lose another 3% on top of that each way that you convert. So it's insane. Don't ever use a bank to convert. Even private banking, which I have, you call them, there's still a 1% fee on the private banking prices. And the private banking gets close. Like they add like half a point to like 3/4 of a point to lock in your rate conversion. You can still do better than that even. So just pro tips there. But let's just go through that example. So you took $1 million back in February of last year. February 2022. Market was roaring. In Toronto, prices were still going up. In Ontario, it was just a frothy market, multiple offers, everything was insane. People were like, hey, rates are not gonna come up, and if they do, they'll come back down quick. Inflation's transitory. You remember that whole narrative? It feels weird that a year ago, we had a narrative that inflation was transitory and that it was not sticky, and by the summer, we'd have rates back down. That was the narrative. The Fed, remember, 2 years ago, went out and told all Canadians, and the Bank of Canada came out and said, hey, lever up to the tits, invest in the Canadian economy, invest in businesses, hire people. We're coming out of COVID. We're gonna stimulate you, and we promise rates are not coming up. They will stay the lowest they've ever been for the next foreseeable 5 years. There's recordings of the finance minister saying that. Of course, that was all wrong, and rates, tripled. Most 1-2% mortgages are now, your HELOC is prime plus 1 for most people. That's 6.7% plus 1. That's 7.7%. Almost 8% interest on an A-lender bank secured first HELOC, home equity line of credit, on your property. So obviously, it's a load of shit. And I was calling their bluff. Obviously not enough. I stopped buying, but I still bought 1 or 2 properties. But anyway, I did slow down and decelerate. slowed my business down considerably. And I'm glad that I did, because a lot of people didn't do that and they're getting crushed right now because they bought at the peak. And it doesn't matter how smart you buy. If the market reps down 35%, you're gonna get slaughtered, right? And the market's slow. So if you're flipping, it might take longer to sell your property than otherwise. But let's go through that example. So you took $1 million USD last February, let's say. You're like, I'm gonna go all in on the Canadian market. Awesome. You take your $1 million USD and you bought you 1.25 million generously, probably really bought you 1.2 million Canadian. That 1.2 million, if you lever out 50% mortgage, and that's like a really, most people are doing 20% down, but let's just pretend you were super conservative, like in case the market goes down, you didn't want to have a big mortgage, so you put 50% cash, 50% mortgage, and so your 1.2 million got you 2.4 million in properties. Maybe that's 3-4 properties in the Toronto area. Maybe it's one big multifamily property. Doesn't matter. The math is the same for this. Let's assume that you bought something that cash flows, that makes sense. And you went the variable rate mortgage because variable rate mortgages always win over the last 25 years. Back testing, variable rate mortgages have always won. The only time in history they haven't won is when there's an accelerated ramp up of interest rates. So 50% of mortgages at that time were variable. More than half were coming out variable around that time. So it was the common sense to do variable. Again, variable was like 1 or 2% interest. It made a lot of sense. It was cheap. Let's say you did a variable rate mortgage, because that was the most common mortgage at the time that mortgage brokers were pushing in Canada. And again, more than half the mortgages. So you did that and you bought $2.5 million in real estate. And then in March, guess what happened? Well, of course, prices started to fall. And so 1 year later, what's that property worth today? That same property, if you bought, or several properties were bought for let's say 2.4 million, which is 50% cash, 50% mortgage. You took that million USD and you bought $2.4 million in real estate in Canada with a mortgage on it. And so you're gonna walk that value today, you're gonna take 30% back on that, right? So what's 30% back on that? That's almost $730,000 in loss in value. That property now is worth 1.7, let's say. That's just what's happening. $1 million houses at that time are now worth, in most areas, about 700,000. In Oshawa, you have $1 million condos that are now selling for 650. So there's variance. In London, Ontario, your $1 million property probably worth about 700,000 right now. And that's a big drop. But it was a frothy peak. Like leading up to that peak, we had 25% appreciation. It was unsustainable. I was screaming it from my YouTube channel that kind of appreciation you don't bank on. That isn't sustainable. And what goes up does sometimes come down. Thankfully, over the long term, doesn't matter. Like if you can hold that property for 10 years, you don't care what the price is now. You care about the price 9 years from now, because that's your exit time. So if you're already, if you weren't planning to refinance it and you weren't planning to sell it, who cares? Doesn't matter. But let's walk through this example. What happens? That $1.8 million, you have $1.2 million mortgage. That means your net equity, if you had to sell it right now or refinance it right now, would be about 500,000 Canadian, 600,000 Canadian generously, let's say. Your 600,000 Canadian is what you have left. You convert that back to USD, you've lost another 15% on the conversion. Your $1 million is lost 15% in value just by investing in Canadian dollars. If you had invested in just cash and converted last year $1 million, it's now worth like $845,000 American. Your $1 million American, $845. But then if you invested in real estate, it would have been even worse, right? The worst timing possible. Same is true if you invested in the NASDAQ. You would have lost even more if you invested in the NASDAQ, the S&P 500. Much worse if you invested in cryptocurrencies or any other growth play stock. But I just wanted to put that out there because the point I'm making here is that this is a phenomenal opportunity on the other side. If you had USD or another currency that has gained strength over the last year and you were waiting to get into the market, because a lot of people I'm following are waiting, it's a darn good time. I mean, now it's equivalent to like your $1 million, if you just held it in cash till now, can buy you almost double the amount of property that it could before, because you have the headwinds of almost 16% boost in the value of the US dollar relative to the Canadian dollar. So Canadian dollars suck to hold right now because they've lost a lot of value. Your net worth has dropped significantly on the global stage. If your plans to retire in Costa Rica, Bahamas, or somewhere in Florida, the United States, you just lost a whole big portion if you were to convert over now and leave now, which is part of why I'm waiting to leave Canada, because most of my net worth, a large portion of it is in Canadian. I think I'm probably like a large lion's share of my wealth is in Canadian, unfortunately. And even my brokerage account, most of them settle to Canadian. So even though I was holding the S&P 500, it'll settle back to Canadian when I sell. So that should help a little bit. I'm shorting, so it actually doesn't help. It's like a pair trade, the opposite. So as the exchange falls, my short position goes up in value, but then the currency is worth less. So when I want to convert, I have to go take my Canadian dollars, buy USD dollars, and then use those USD dollars to buy the index to close the short. Right? You have to go buy the index to close out the short position. So unfortunately, I'm getting crushed by my currency, even though I'm shorting, my shorts are up like 25%. The currency has crushed me 15, so I'm making very little on my short position, unfortunately, because I didn't hedge for the currency destabilization. I should have. I should have known Canada would have pushed out and not keep up with the U.S. What I would like to see is Canada go harder on their rates. If they continue to hike higher and higher, we should see the stability again and bring CAD back down to like $1.30. It's more of a safe 6-month range we've seen. So hopefully we see the market bounce back a little bit. Some of the stocks, I hope that they come back. I'm still bullish on the economy and I want it to come back. I just think there's more pain ahead, and I think investors are too optimistic about what's to come. I think there's more pain ahead, even though the market's forward thinking. I guess recently the bond market has, that inverted yield curve has gotten much, much worse. So I'm starting to feel better. I'm starting to close my shorts out and get more of a neutral position, getting ready to go long. I'm just waiting for more of a correction, but I think we're getting there. So that's my forecast. People like to know what I think. That's what I think. Stickman Finance says, Mike, prices in Oakville are sky high rocketing. Have I missed the boat? Well, it depends. Like some people talk about Oakville. Oakville's a very rich area. In some areas, what you're going to see is that there are cash buyers. Florida's another example, almost unaffected. It dropped a little bit in price, but people who are strong cash buyers don't care about rates as much. In fact, people who have a lot of cash, they tend to be doing better now. If you get a pile of cash and you're a really risk-averse investor, risk-averse investors love real estate. They love, treasuries. They love bonds. They love, mortgages and super safe fixed debt instruments. Real estate's right up there with a really safe asset class that like insurance companies and a number of other large institutions that are very risk-averse tend to park capital into, especially big quality blue chip buildings. They love to park their equity there and they get a safe, consistent return. So I will say this. Oakville's full of rich people who have a lot of cash. And so the rates going from 2% to 7% haven't affected them all that much. The rich are richer than they've ever been, though their stock accounts might be down. I think a lot of the Oakville investors, I don't want to be racist or anything, there's a lot of Asian money in Oakville. And a lot of the Asian investors that I know in that area hold on to a lot of cash, invest in GICs and treasuries and safe stuff. So they're unaffected, in a large part by any of the crypto drawdown or, the stock drawdown, the equity drawdown. They didn't feel a lot of that because they were holding on to, capital that was parked in safe vehicles where they're getting a guaranteed 4% or whatever. And so for those people, their cash is still there and then properties have fallen a little bit. So across the board, we've seen a falling. There are some exceptions. Luxury real estate hasn't been as affected. For some reason, luxury real estate has actually kept up and outpaced. So the rich are not paying less because the richest underlying assumption is this. Like, they can afford it. It's the luxury for them. They want that luxury. Whether the economy's in a shitter or not, they don't care. They weren't going to use a mortgage anyway, or if they did, it was, well within their qualifying limits. So where, now people trying to qualify at 6-7% interest, the average person making $60,000 a year, they can't qualify for a $500,000 mortgage. Now they qualify for $300,000 at the new stress testing rules. Well, the rich person, they could qualify for $5 million, and they're only going to get a $3 million mortgage. They don't care. It doesn't affect them in the same way that it does the average person. So the average person right now is being squeezed because they can't afford a big mortgage. So they literally can't pay more for the house. Even if they emotionally want to, the financial side won't back them. They won't have the money to do it. So for that reason, that luxury real estate hasn't been affected nearly as much. You should see a pullback eventually in that space too. Those sectors will be affected. Those businesses will be affected to an extent, but it could be potentially not as drastic, let's say. And I think the bottom echelon too, like the entry-level houses, also should hold up really, really well because the people in the middle tier who are looking at a $500,000 house might just adjust their budget now to $350,000. So there'll be more competition at that space, keeping the prices bouncing off the bottom. So in that way, I think those areas of real estate do fairly well. Multifamily also strangely hasn't fallen yet. The cap rates are staying strong, even though like 3-4 cap rate. People are borrowing at 6-7%. And these large multifamilies, these 100-unit buildings in Toronto, are generating a 2-3% return. But they have to borrow at 7%. So every dollar that they borrow with mortgage money, they lose 3 to 1. Used to be the opposite, that you would borrow at 2%, CMHC guaranteed, and you get a 4 cap, and you would have a spread there, a positive spread between your cost of debt and your return on asset. Now it's the opposite. Now it's your cost of debt's higher. So every dollar you add of debt just is dangerous. It's a bomb, crushing your cash flow. And so then it's become speculation. And so there is a lot of speculative money. There are a lot of insurance funds that are, that have billions to park of like whole life insurance money and things like that. And those guys, might prop the market up a bit, and guys like BlackRock might come in and institutional money might come in and buy some, but the capital is drying up. And so largely those cash buyers will become satiated. And when they do, there won't be enough demand to satiate the supply. And typically real estate takes 2-3 years to feel out a cycle. So what we should see is that the comps take a while, and it is falling, but it will take longer for the bottom of the market to occur. As an example, to look at historical, in the 80s, when they raised rates up, it took almost 5 years for prices to bottom. Inflation crushed real estate. It ran way higher than the appreciation on real estate for a number of years. Over the long term, real estate outperforms inflation, but over short bursts of time, like in 2008, the price fell a lot in 2008. Then it fell more in 2009, but not much. And then in 2010, it fell again, a little bit more. And then 2011, it fell again. And the bottom of real estate happened towards the end of 2011, was the bottom pricing for real estate in the US. People think 2008 was when it happened. It took 3 full years before we got the bottom price point. The good news is that people started buying in 2009. They had 5% depreciation, 3% depreciation. Who cares, right? Like it was the 20% first drop that everyone really focuses on, that big drop the first year. In some markets in the United States, it was a 35 and 40% drop over an 18-month period. So it was a big drop, similar to what we're feeling in Ontario and in Canada right now. But I think that if we look back to historical performance, it can help sometimes to illuminate how things may play out again this time. And this time might be different, but it isn't that much different in the sense that real estate is still a slow transaction. It's still, as great as technology is, it still takes 4 to 6 months to close a deal. I don't know why. We just haven't gotten that fast from the time when you decide you want to sell your property to when you get it listed to it just takes time. Stocks have gotten faster and more efficient, and information process has gotten faster and more efficient. So maybe that information will disseminate faster into the marketplace, and we should see a faster resolution to the bottom. And so I'm hoping that sometime next year, we're going to see the bottom. We're getting a little bit of a bounce right now, but I think there's still further pressure down. Like in January, February actually are up in Ontario. We're seeing trending data up. That's coming into the spring heat. That's normal. People through COVID are waiting to list their properties and stuff, and that's coming up. So there's a lot of different macro factors happening here. I still think more pain is to come into December of this year, and I'll be excited to buy more into December of this year. I'm still buying because I run a real estate business. So for me, if prices are somewhat stable, I can make a lot of money. As long as they're not falling like a rock, I can make money. I buy smart enough that if market falls 5%, if appreciation's 0 for a year or two, if we're flat for 3 years, I don't care. Because I don't play with appreciation. That's gambling. That's speculating. I play in the space of, here's the value I can create right now. If I buy this today and the market changes, none, 0, no appreciation. Here's how I can make money. Here's how I can make cash flow. Here's how I can unlock the value in the property. What can I do to it? Can I renovate? Can I do a $100,000 renovation for $50,000 by bringing in cheaper sub trades? So the market might price that renovation at 100, but I can get it done for 50. That's a competitive advantage. That would give me an edge, right? Or as a manager, if the market's saying, hey, everyone's paying 10% management fees, but you can get it done for 5%, that's an edge. If the market is horrible at property management, and most people have bad tenants destroying their properties. If you can do a little bit better job than most of the property managers, that's a competitive advantage. If you can buy smart, that's where I excel. That's where I add the most value. I also do in the renovation space, probably renovate cheaper than anyone I know, but that's not a space that I can scale at. It's hard to do that at scale. I can't find 1,000 contractors that'll all work super cheap, or else I'd have to find more people like me that know how to cost cut and just grind them. And there's the labor. I'm discounting my time, right? The goal is to run systematically and passively, right? And so the only way I can really scale is on the acquisition side. I can buy deals that are at 70 cents on the dollar all day if I build a big enough pipeline and I get acquisition managers and I do what I love, which is negotiate. Get in there and throw out offers in people's faces. And 1 in 100 they accept, and those 1 in 100 deals are unicorn deals. And because no one else is throwing out 100 offers at all, they're not finding any. They're looking at MLS, they're kind of perusing part-time. If you're doing this part-time, you don't know what you're doing, you haven't put your 10,000 hours in, you will not outperform me. I will beat you every time. I will beat you to the deal. I have a better reputation, so I will win when we're negotiating. They'll choose my offer over the other person's offer. That's how you build an acquisitions business, is around all of those pieces, right? Like any business, this brand comes into play, financial backing comes into play, experience in negotiating, knowing what you're looking at too, because we might look at the same deal and someone says that's not a deal. And I look at the same deal and I'm like, well, all we have to do is just finish this basement and now it's a duplex and all of a sudden it's worth, and it cash flows amazingly and now it's worth this much more. Or I might look at the property and they see nothing and I see we could build a 3-car garage here. All of a sudden this $600,000 house becomes a $900,000 house, and that 3-car garage is $50,000 to build. Okay, wow, we just unlocked $200,000 in value that no one else saw because they didn't think about putting an addition on, or they didn't think about a reposition or repivot. So it's often the lens at which you view the world helps you to, architect and make those deals. A lot of deals are created. They don't just, like, I've sent deals to people and they're like, well, this isn't a deal. I'm like, you're not looking at it from the right lens. And so it's all about the lens you use to view the world. And that's why it's important to put the hours in. That's how you outperform in the real estate space. All right, I'll go to the Q&A again. So that was the Oakville one. The next one was from David. Hey, Eric, how you doing? David says, seen an Instagram post about property tax reassessments in 2024. What province is this? Alberta does it annually. So in Ontario, we have the Municipal Property Assessment Corporation, or MPAC, and they came out and they valued the homes and they phased in new values every 4 years. It's stepped in each and every year, so it's not all at once. But what we're going to see is that if you look in Ontario, especially in London, Toronto, the MPAC value, if you go log in on the system, almost every house is at 50% or less of market value. Most of my properties show 200,000 MPAC, and they're $600,000 properties. My house shows a $500,000 MPAC or $600,000 MPAC, and I think it's worth $2.4 million. So if they were to actually adjust the MPACs up to current market value, and because we've had 100% appreciation in 5 years, and every 4 years they reassess it. In the last 4 years, the price of everything has doubled, even with the pullback, almost doubled. So if the mill rate, so the mill rate is in your municipality, you will have a rate that you're taxed at. It's like 1.3568, whatever. They'll come up with a percentage. Usually it's 1 to 2% of the value of the property every single year is the tax rate. And they decide based on how much revenue they need in their municipality. They'll decide based on that how much to charge. They look at the value, the collective value of all the properties, and they say this is how much revenue we need, and here's the rate. So what happens is when the value of these properties doubles, if the mill rate or the rate that they're charging doesn't fall in half, we're going to have a big problem. And whenever you have a blank check for the city, how do you think government handles that? Is government like, hey, our revenue just doubled for property taxes over the next 4 years phased in? Are they going to be like, oh, we don't need that much money. Let's just drop the property tax rate because now properties in London are, double. They've phased in double. Should we then adjust that? Oh, no, they'll find a way to spend that money on homelessness issues, on bureaucratic waste. They'll put a park bench in for $1 million, a lot of things that don't matter. Homeless matters, but I think it can be handled better in the private sector. And I think the public benches for $1 million make no sense. You'll watch like 6 guys standing there, one guy's working. They get there at like 10 o'clock. They go for lunch for an hour. They do 3 hours of work. You get an independent private contractor to do the same job in like 6 times less the speed and 6 times less the cost. But whatever. We'll just pretend the city actually is efficient. They're not. It's a lot of bureaucratic waste in general because their incentive is to grow their budgets every year. Each department within the city wants to not, like if they have a little bit of budget left over, they find a way to spend it so they don't get it cut next year. That's just the incentive model within government. I worked in government, so I know exactly how it operates. One of my internships. But so that's what that comment is referring to. That Ontario is going to see phasing in as they reassess the properties. Alberta hasn't had any appreciation over the last 5 years, not a lot. They had depreciation for a number of years as oil was doing very poorly. So they don't have the same issue. In Ontario, properties have jumped in value significantly and property taxes haven't, really kept up. It would be crushing to raise property taxes at the level if MPAC comes in and says properties are worth double what they were in 2016 when they last assessed or 2020 when they last assessed it, we're going to have some major problems if the tax rate doesn't drop. So that's what that post was referring to. It was a friend, Mike's post, who I reshared. Will says, I'm buying the dip. Right on, Will. Good to hear. Praying Meta comes down. It seems to be holding. Stickman, I love Meta. I sold my position in Meta in December for liquidity reasons. I needed to show a bunch of liquidity to get a refinance on one of my properties. And so I had been looking for an opportunity to buy back in. I missed that opportunity as it's been like 20%, 25% rip up. I think Meta is one of my favorite companies. I had a good feeling that, long term, that Zuck would pivot. If he didn't pivot, that he would find a way to raise additional revenue. As an example, paying for a verified checkmark on Instagram. I think that's a brilliant idea, following Twitter. I know all the left is like throwing shade on Twitter, but like social media is like, oh wow, this is all the social media companies like, example, Meta, which runs Instagram and Facebook, was like, and Messenger and WhatsApp, was like, this is a great idea. Let's generate some revenue. I love that because I would happily pay to be on a platform, where I connect with almost everyone that I connect with. I would happily pay for that. So I think it's a brilliant idea, great company. Half the world's eyeballs are on their apps almost daily. I can't think of a better app that exists or a better control of connectivity between people like Apple has a good market share. You can't deny. A lot of us use. I use an Apple iPhone, right? The iPhone 13, and it's a great. I love the ecosystem. I love Apple, but like, not in the same. It's a device. It's not. No matter what device you use Facebook, you use Instagram, right? Whether you're on Android, a Samsung phone, an Apple phone, whatever. It cuts across all of them. If Apple came up with some like weird, change to their service, I would. I'm not loyal. I would switch to Samsung or a different Android phone, whatever. You can't switch out of Facebook and Instagram. That I literally have people that I talk to. I don't even have their phone number. I only communicate through Messenger app. That's how I know them. For years, that's the only way we've communicated. And that's just the way that it is. So yeah. I extremely bullish on Meta. I still think a $300 price target in the next 5 years is totally possible. But is there more pain? Potentially. There's a possibility that stock falls again to where it was, around $100 a share. Raz says, why does Canada have to follow the U.S. lead on rate hikes? Ain't a low Canadian dollar good for the economy because export dominant? So one of the challenges, I think, for Canada not following suit is that the dollar, people are going to play, you're right. I mean, Canada does export a lot. We also import a lot too, right? So from an import perspective, there's a lot of things that we import that will get crushed. So those businesses where you're importing will be hurt. People will arbitrage the difference too. So as the Canadian dollar, people will flee from the Canadian dollar as they see rates not holding up, right? If the U.S. starts paying more, people are going to flee to Canadian dollars and park them in U.S. dollars, right? Also, strangely, as the market falls, as the U.S. equity market falls, as the U.S. equities fall, the U.S. dollar gets stronger. Times of turmoil, people feel safe in the U.S. dollar. They don't feel safe in the Canadian dollar, partially because Trudeau would freeze bank accounts and steal money if he wants to. It's a very communist, socialist country, so the Canadian dollar is not strong in that way as well. But you're right. One challenge also for the Canadian dollar is that the cost of lumber, oil, lumber especially, has fallen significantly. We're seeing a pullback in commodity pricing. So, yeah, I mean, it's not good, I guess, for anyone who imports. You're right. For exports, it would be desirable. You would think that the U.S. would want to import more of our goods if the Canadian dollar gets weaker. So, in turn, it should drive, the U.S. dollar and Canadian dollar closer to parity again. In the long term, that's my forecast. I don't see, for sure in the next 5 years, $1.20 is going to happen. $1.20 U.S. dollar by $1.20 Canadian is going to happen in the next 5 years. I'm sure of that. So if you can wait, that will happen. It also may be $1.45 at some point in the next 2 years. So there's a huge range of what can happen. I'm hoping that the U.S. does not continue to get crazy with rates. At the same time, though, if they were to leave rates and just do we'll hold and wait and see approach, what we will see is inflation will continue to be a persistent problem for longer. Deflation is a problem. Disinflation is the idea that you don't fix any of the inflation that's already happened, but you slow down inflation. The government has decided in the US, and pretty much all of the economies in the first world, they've said, hey, 2021 inflation got out of control. 6-7% inflation on paper. Really, it was like 10 or 12 for all the areas that matter. But whatever. They adjust the CPI, the basket of goods, continues to be adjusted. Again, in January, they adjusted how they calculate inflation. But if you use the 1980s method of calculating inflation, inflation's running at double digits. But whatever, we'll go with their math, right? They got their reasons for why they keep adjusting inflation, so they look good. So inflation running high, right? You would think that if we have like almost 20% inflation over a 2-3 year period, they'd want to fix that. No, the government doesn't want to fix that. They want some inflation that's already happened. They just want it to be stable in the future so that people can feel comfortable in the future doing business. They don't care what's happened in the past because inflation in the past should drive assets up and allow them to tax that said asset with fake value they've been created. They can take some of your wealth. If your buying power is the same, but the asset is technically worth more, they can and your buying power has effectively dropped because they've taken some in tax. So that's just, the government's incentivized to always have inflation. They want to print themselves out of debt through inflation, especially the indebted nations like the United States, which have some of the worst debt to GDP. Canada also, very horrible. So of course we want some inflation. Disinflation is their target. So they're never going to fix any of the inflation that's already happening. And it continues to happen. We're running at like a 5% inflation on paper still. That's still happening. We're still inflating like almost 0.5% a month. Every month, price of stuff going up. They're not fixing any of that. They should. I mean, we should have some deflation, but that would be horrible for the economy. So their new target is get us down to 2% again. and try to keep it there. And the problem is, if they bring rates way up, they'll bring inflation down. That's the only tool they really have. The other tool they have is government spending, but they're gonna play with that lever at all because Congress doesn't want to stop spending. Joe Biden definitely doesn't want to stop spending. Our Liberal government in Canada definitely doesn't want to stop spending. They want to spend more than ever before. And to service all the debt they borrowed from the past years, they need to bring in additional revenue. It's hard to get extra tax revenue from a people that are, real estate's falling, crypto's falling, stocks are falling. There's losses all across the board. And they're looking and people are getting laid off. So there's less revenue to tax. So the rates have to come up dramatically, and good luck getting that pushed through. Good luck within a year trying to raise more tax revenue. So all they can do is just go further into debt. Unfortunately, that's just the nature of how this is going to probably play out. So rates are probably going to go higher for longer. Hopefully, the Fed stays strong and doesn't squirm. If they hold or drop rates too early, as in don't go hard enough, don't raise rates enough, they're talking we're going to get at least 50 basis points more in rate hikes to come. Probably 75 to 1% rate hikes still this year to come. So the top isn't in yet for rates in the US. Canada should follow suit. It would make sense if they did. However, Canada was more aggressive in the beginning with our rate hikes, so I can see the arguments people are making for why Canada's pausing, and maybe pausing is the right call. It sucks short term for me because I'm trying to bring Canadian dollars to USD, so I'm secretly praying the government. I have a bias that I'd like to leave Canada, and so I certainly hope that the Canadian government can get their shit together. Long term, I love Canada. It's a great country, has a lot of natural resources, one of the largest countries in the world, has the most usable land of any country in the world. The most. And we have the most fresh water, some of the cleanest air. A great overall country, great topography. Russia is also huge, right? But compared to Russia, Canada's way better. Most of Canada is good, fertile, rich, great soil, decent climate. We share a border with the United States, the most powerful country currently in the world. So Canada's a beautiful country, has a lot of potential. We're immigrating a ton of additional people, over 500,000 people a year coming into Canada. So that's like 3% of our population, something like that, each year, compounded. So Canada will have 100 million people in no time. And I'm really bullish. Canada has a lot of potential. So I love Canada as a country. I will continue to invest in Canada. I just don't want to live there as a tax resident. I gotta go to the Bahamas. I gotta get out of here because the personal tax rates, the direction that they're going, 60, 70% personal maximum marginal tax rates are possible. There's talk of bringing things from 55 to 60, 65 in Canada. And the way that the budgets deficits are running and the way that the debt bill is growing, someone has to pay for that at some point, right? Forget just servicing the interest cost on it, but actually pay some of it back, right? I know the plan is to inflate our way out of debt so that we never have to pay it back. Because if you owe someone $100 and inflation over 100 years, destroys the value of that, you're paying them back nothing, right? Because $100 has no buying power in 100 years. So the eventual goal is to inflate our way out of it, I guess. I don't know. That's one play I've heard. But I love Canada, great country. Overall, I'm extremely bullish on the long-term fundamentals for Canada. As a long-term rental market, the rent controls are ridiculous, so I would never want to own a long-term rental. I would always do short-term rental friendly projects, so like hotel, motel, resort. If you're going to buy a property, Airbnb, that sort of thing is much, much better. Student rentals are fantastic because the students leave naturally. They don't stay. And they're by the bedroom. So it's just much more flexibility to keep the rents up with market pricing. And Canada has this is a really bullish signal for Canada, but we have a really big supply-demand imbalance. And also, I mentioned this earlier, I think, briefly, when I talked about luxury housing prices, but the cost of labor has not really come down yet. And so the cost to build is still so high. Like cost of materials for everything at Home Depot, Rona, it's crazy. It's up 100% for a lot of things in the last 2-3 years. That's wild. You go to Home Depot and walk around, inflation's 100% in 3 years. 20-30% a year on almost everything. Plumbing section, electrical, especially wire electrical. Lumber's come back down, but still inflated 30-40% over a 3-year period. Drywall's crazy. All those little things like compound and screws are up 100%. Just nuts. And will they ever drop those prices? Probably not. Like the cost of their margins, so their cost of goods, their COGS, might be dropping, but they're going to still sell it for the same amount to generate revenue. They're just going to have fatter profits, realistically. So that's a problem with inflation. It's sticky. And then once it's become entrenched, then all of the working class, the people who are working, the entrepreneurs raise their prices, and the working class people demand higher wages. And wages are up almost 7% for the last year on average. There's a new study out. I forget the source of the study, was either Workopolis or I'd have to check, but I saw it on my feed and I thought, wow, that's really bad. That's a signal of a price wage spiral. We don't want that. We want people in the streets unemployed. We want people screaming in pain. That's when the rate hikes stop. That's when inflation gets under control. They attack the demand side problem. People don't have money to spend, prices fall. That's not happening. People have cash still. They're racking up debt to their eyeballs. They're getting raises at work. It's a dangerous game. The price wage spiral would lead to inflation being a multi-year problem like it was in the late 70s and early 80s. It took a decade. Paul Volcker had to just basically, he was the Fed at the time, had to basically destroy the market and get rates almost to 20% to curb inflation and stop it. So I hope we don't get to that. I hope that things are faster and better now. The cycle doesn't take as long. Information is more perfect today, and the dissemination practices for information are faster, thanks to social media in large part. That should help. It should make the cycle shorter. And hopefully, it seems like Jerome Powell and his group of people are very hawkish. And so I like that, in that they're going to be hard on us. And he continues to say, every time he gets on, the market gets like, he's going to pivot. And then he gets on TV and he's like, or he gets on in testimony, or they write a report, and it's like, I am not wavering. We're going to get inflation at 2%, whatever it takes. I like that. I wish he would talk harder and dirtier to get inflation under control, because inflation is evil. It eats your assets buying power in a big way. And for anyone who's early retiree or who isn't exposed to assets that will, over the long term, beat out to inflation, are getting crushed. And in the short term, when inflation runs wild and rates go high, even the assets you use to hedge against inflation get crushed as well. So that's something it kind of sucks, because like inflation's 10%, and then all the assets you buy, crypto, you buy stocks, you buy S&P 500, you buy the NASDAQ, you buy any company on any of those, you buy real estate, and they're all falling. So you're losing buying power, and all the assets we're holding are all losing value at the same time. So it's like a double 1-2 punch, and it really sucks. The good news is that this inflation over the long term will force these assets up. Because remember, if you zoom out 5-10 years out, it's way up. Everything goes up over time. If you're diversified, you own a large basket of many properties in many areas, you own many stocks from many different indexes, quality companies over the long term, a big portfolio of them, you will win always. You will beat inflation always over the long term. People try to be short-term mindset. They get in, get out. Don't do that. Get in, hold, long-term win. If you're going to try to time it, take your cash and slowly buy on the big red days. That's all you can do, because none of us can predict the bottom. We try our best. If I have my crystal goggles on, I still think the NASDAQ or the QQQ, I think at 260, it's a great buying opportunity. We were there at the start of this year. We're up 11% from that point. I think we could retrace a lot of that. It's a real possibility, but I don't know. We could be in the next bull market. I don't think it's likely. I think there's a lot more pain ahead. But remember, the market is future looking. And so they're trying to look 12 to 18 months out. And so if it looks good 12 months out, the market might rally while there's pain in the streets. So does that make sense, guys? People are suffering, but the stock market is recovering because it's forward looking. When the stock market has fully recovered, real estate will be at its full bottom, if that makes sense. If you're trying to look for an indicator, when the stocks are all recovering, that's when we should see the bottom of real estate. It's a lot more lagged from when the recovery happens in stocks. The recovery happens in real estate after. But typically, most of the pain happens, then it's a slow trickle or a flat market. So I would say it's more likely that we see flat or slightly down. You're definitely not going to have a big rip up. We're not going to see a 20% appreciation in the next 6 months. It's not going to happen. So if you're sitting there with cash being like, I don't know if I should deploy it, wait until you find the right deal. Don't rush into anything. There's lots of opportunity. That's my advice. Okay, I gotta go to the Q&A real quick. I'm already at my time limit, but I'm gonna go through this rapid fire. If you're watching this, you're one of the 48 people who are watching this right now, hit the thumbs up button. We have 15 likes. Let's get that to like 30 likes right now. That'd be really cool. If you're watching the replay, thank you for watching the replay. I appreciate you guys. I gotta get down there and try to go in the water park a little bit there and try to enjoy that with the family for like at least 5 minutes. So I'm gonna go real quick here, guys. Any questions, throw them in now or forever hold your peace. I think I'm down here. I was just past Raz's question there. So Grinder, hello, Mike. Since ADUs are legal in every property in London, do you still have to apply to the city? Thanks. Grinder, as I currently understand it, Bill 23 has not been fully absorbed or approved within London. So there's a narrative that ADUs are allowed everywhere, but they are actually not allowed, because the London plan, as an example, I think like something like 10 or 15% of properties in the north, south, and west end of London are on septic, as an example, on septic tank or well. Those types of properties cannot have an ADU. They go through zoning approval. It's supposed to be, Bill 23 says, hey, anything under 10 units doesn't go through zoning, you automatically get a permit. But they're still saying in London that it has to go through. Hopefully they make some amendments and some changes to their bylaws to allow that. Currently, ADUs are allowed where they'll allow them. And so that means many properties, like ones that are not on municipal water or sewer, too bad. You had a big mansion at the edge of town that's on the border. If it was, just outside of London, it'd be allowed in Middlesex. But if you're inside of London, no, not allowed. So there are still lots of loopholes where it's not allowed. But is it a great thing? Yes, I'm super excited for it. I've been pro accessory dwelling unit, ADU. I've been pro adding units to properties. I love what Doug Ford's done in Ontario, forcing 3 units in every property down every single person's throat. What that means, though, is if you have a duplex zone property, it means nothing. Whether it's zoned residential or zoned duplex, I see a lot of agents putting in zoned R2-2 in London, which means allowing 2 units. I'm like, no one uses that process to convert anymore. Whether you have 2 driveways or not, whether you're zoned duplex or not, you're allowed to have 2 or now 3 units no matter what. So if you have duplex or triplex special zoning you had to fight to get in the last 5 years, you went through a whole process with the city council, which I did on a couple properties, all of that work was for nothing. So in some ways, some properties have lost value, because if they were valuing the fact that they were zoned duplex, zoned legal triplex, it means nothing now, because every property can become that now without any zoning approvals at all. It's a good thing. We're trying to create affordable housing. We have a real issue here in Ontario. We do not have enough housing. It's a real problem. There's a massive lineup of people that need a place to live. So it's super huge that we get that. Sorry, the lighting is super horrible in here. I got one little light in front of me, so I'll try to get closer so you guys can see me. I gotta do some Q&A here. Grinder, do you still have to apply to the city? Yes. So the last part of your question is, you still have to get a building permit and comply to all fire and building codes. You still have to put fire drywall in. You still have to do all the things you're gonna have to do to make it legal and compliant from a fire and city bylaw perspective. Just not through zoning anymore, which is a huge time saver. That used to be 6 months to a year waiting just for approvals before you even get a building permit. Zaleen says, hi Mike, do you think it is worth it, all the trouble and expense of cross-border tax, if a Canadian buying just one rental property in Texas, limited money to invest, so plan to start with one property? Zaleen, I think that there is a lot of cost to avoiding double taxation. You, as an example, have to set up an LP-GP structure, and that means that there's probably $5,000 in setup fees, and then there's $1,000 or $2 a year per $1,000 per entity per year. So if you have a couple entities, you're talking a couple $1,000s a year. So if it's one small property, most of your profit could be eaten up in administrative and accounting fees and legal fees to run something like that. So if you're gonna buy one property, just buy it in your own personal name. That's my thought. You have no double taxation at all. You can buy that one property in your personal name, no issues. Get a good insurance policy to protect yourself, and you'll be okay. Good insurance, super important. You could also, that's the crude version for one property. If you're gonna do lots of properties and continue to buy properties, the right structure is super important. My challenge, and I wish I had someone following me right now who's like a super good accountant that could weigh in on this, is like, if I end up in the Bahamas in the next 2 years, let's say, do I want to set up a structure like that? Because a Bahamas Corp can own, say, a Florida LLC for every property and file a return in the US as an alien. I can 1031 exchange from the Bahamas. I get a 1031 exchange as an alien tax resident in the US. I don't even have to be a citizen in the US to tax exchange. And the depreciation schedules in the United States are so aggressive and so beneficial that you pay no tax at all. You could own the property for 10 years and pay no tax, because you use depreciation schedules to get your operating income. Even if there's a positive cash flow, you get it to zero through depreciation schedules. And then you just sell the property and buy something bigger. Through 1031 exchange, you never pay a capital gain. So you just never pay tax ever. US investors can do that. That's a pretty cool power. You don't have that in Canada at all. So that's another reason why I want to renounce my Canadian citizenship, because Canada says, okay, you can 1031 exchange in the US, and the US says, fine, you don't owe us any tax, 1031 exchange, pay us no capital gains tax. But Canada still wants a piece. They're like, we don't care if the US government says you owe us no tax, you 1031 exchange. Canada still wants a piece. So Canada's really the problem from a tax residency perspective. I will still invest in Canada. I'll still have a corporation in Canada. I won't live in Canada and have tax residency in Canada. Over the long term, that'll be millions of dollars in savings in my pocket.
I could still be in Canada 5 months a year and visit family and friends and do business in Canada, but I don't think that I will live long term in Canada because the personal taxes are so punitive. Whereas in the Bahamas, there's no personal tax return at all. You don't even file. You file nothing, no return, no disclosure, nothing. You have a crypto, $1 million turns into $1 billion. We don't care. Don't report anything. You buy Tesla stock, it goes 10x. We don't care. Don't report anything. No capital gains tax, nothing. That's a sweet setup. 90 days a year. You even need to set up your primary residence there, live there. For me, it'd be like half the year probably I'd be there and I'd be traveling for business the rest. But sweet setup in the Bahamas because it's so close to Florida. You're 60 miles apart. The same day you go back and forth, like a 30-minute commute by boat or by plane. It's just super awesome. So that's what I like about the Bahamas for tax planning. But again, I'm stuck in Canada for a number of reasons. Partly still family stuff, but partly the Canadian dollar sucks right now to convert to USD to leave right now. And also partly that I have some really nice losses from the crypto and the stock portfolio that I can use to pay no tax on my corporations for the next 2 years. As I earn back those losses as my portfolio went down, now as it comes back, I can get that back tax free. So I'm not in a huge rush to leave Canada, but it's on my radar. Definitely on the radar. All right, I go faster. I'm already like an hour in here, and I started late tonight. Is a cash flow position in Alberta better than appreciation play in Ontario? Why don't you just get a cash flow play in Ontario? I don't see anything special about Alberta. You can do that in Ontario. Lots of smaller places in Ontario where you can get great cash flow. Next question was, friends saved up 60,000, asked them how to grow money and skill, interested in real estate. What advice would you have? Start by just looking at properties and throwing out offers, practicing, watching the content, practicing what you're watching, what you're learning. Super important to be able to watch and then apply what you're watching. A lot of people watch and don't take action. You've got to take action on it. Super important. But yeah, I would say just buy the indexes for now, and you can always, if you find a good deal, you could transition your assets into that deal, into that property. There's lots of other asset classes you can look at, but I like real estate. If you put the time in, you can get a great return, better than the market. If you're not going to put the time in, you're not going to develop a competitive edge, and you're going to work your full-time job, and you're not going to focus on real estate, you're going to do like 1 hour a week or 2 hours a week and look at a couple properties, you're probably not going to outperform. You might as well just buy, if you're going to invest in real estate, you might as well just buy a real estate investment trust or partner with someone 50-50 and be the money partner. Have them do all the grinding for you. That will outperform you being by yourself and just doing a passive crappy property that you didn't spend the time to get a good deal on, and you aren't doing anything special to deliver better returns from a management cost control perspective. So it might just be better to buy a real estate investment trust shares in a publicly traded REIT that's going to generate you like a 10% yield every year. But to each person their own. Some people like to touch and feel their properties. I like to physically have real estate I can go touch and see, and I feel better being in control. Ash says, would you ever be overemployed? Work for many employers at once, full-time without anyone knowing. I hear that's a big thing right now. The double full-time job economy gig. I read an article about it. Super cool. The idea is that basically you're working like from home remotely in 2 jobs, and one job you're like, maybe one job schedule is like 8 to 4, the other job's like 12 to 8. So they overlap for like 4 hours, but you're working from home remotely. And so no one's tracking exactly the hours you're putting in. You're getting the job done because in reality, like most jobs, if you're efficient and you don't waste time talking to coworkers and, just like not being productive, standing around the water cooler, so to speak, you can get most jobs done in 5 hours a day, and 3 hours is just fluff. So in theory, you could do 5 hours and 5 hours of concentrated work and get 2 full-time jobs done in 10-hour a day. It'd be stressful. You'd be having no breaks and maybe a couple breaks, but you wouldn't be having a lot of cush time. But definitely, I know people who are doing that. Have I done that? Yeah, I moonlighted. So I worked a full-time job in consulting 8 to 5, but I also ran a real estate portfolio. At one point, I had like 100 bedrooms. Some people consider that a full-time job. Renovating all these properties. I had like a dozen properties, right? That's acquiring all those, renovating all those, renting them out. I had no property manager. I did all my own property management. So I placed my own tenants. I answered the phone. For a long time, that's what I did to learn. Now I bring property managers in. I have no interest in doing that. I'm too rich for that. My time isn't worth doing $20 or $30 an hour tasks. But in the beginning, it was. I worked as a consultant making 60 grand a year. My time was worth 29 bucks an hour or whatever, right? Like that's what my salary worked out to anyway. So for me, it was, it made sense to do that and to learn and to build, do the reps and get the experience. So yeah, totally can be worth it. I don't know a lot about Austin, Texas for buying property, so I can't comment. I hear the cap rates are pretty fantastic in Texas. Jonas is doing good. Andrew says, can you comment on Ben Humble if very comfortable? Seems like a guy who's super passionate and dedicated to training people and giving them insights on basically anything with social media, running a business. I think he started in wholesaling, and he's honestly a great wholesaler and a great negotiator. So as far as like his sales and negotiation skills, I definitely think that he has that. I don't want to talk ill of anyone, but yeah, just in general, you have people who are really great at sales, like Alex Hormozy is amazing at sales. Grant Cardone, also amazing at sales and negotiating, but are they super ethical people? Like, do I think Grant Cardone's a super ethical person? I think he probably takes advantage of some people. Grant Cardone, I mean. But yeah, I don't know. I think each person's their own, and I think that there's some tremendous value. I really like Ben. I think that his stuff, his original content like 6-7 years ago on skills get the deals and the wholesaling stuff was just super awesome. I think all of us at the top all of us guys who are crushing it in the space all have egos, and so that comes into play. If you like that person, cool. Some egos rub people the right way, some don't. Overall, I think he's a chill dude, and I like that he's always hustling and grinding, and he respects his wife a ton, and he brings faith and religion into what he does, and I think there's some underlying good morals there for that. So yeah, I don't know. I don't want to do that. I want to dominate the stream with that question, but Will says, traveled to Europe this past summer. People exchange WhatsApp info opposed to phone numbers. That's 100% true. Every country I go, we just do WhatsApp numbers. In Bahamas, I'm talking to people, even between the US and Canada, it's always WhatsApp. So, and WhatsApp's owned by Meta. So Instagram, Facebook, WhatsApp. They control the communication of the world effectively. That's how you private message people. Is pretty much the way. I traveled, yep, same thing. Do you churn credit cards to travel for free? I used to do a lot of that. I don't anymore. It's not been as important as it was. Mike says, is the realtor licenses beneficial for investors to have so they can make additional active income and provide any advantages? It does come with some advantages. That's why I eventually got my license. I'm a licensed realtor. We have our own brokerage. It's definitely something that, I like that small feel. I like that I have control of the data. I like that if I want to put an offer on a property, I don't have to go through an agent. It's faster and more efficient for me to do the offer myself. I don't have my license in Florida right now, so I am going through a number of agents right now when I do offer an MLS. A lot of the stuff that I buy isn't on market, but when it is on market, I work with a few agents and we just set up a referral agreement. So being an agent does, even in Florida, provide benefits because I can get some commission back, some of the buyer's commission back. So yeah, of course, it's been super beneficial. Over the years, I've probably saved $400,000 or $500,000 on deals that I've done just by being licensed. Save on the listing side and the buying side. And that's without even me doing work. That's finding another agent and co-listing with them. They do the work, and because I'm an agent, I go on the listing with them and they work for half the commission. So you can negotiate some great deals that way. Co-listing is very common. So an agent doesn't have to do any marketing or anything. You just give them a layup deal. You're like, hey, here's the property. I got the relationship. You just got to do the work to sell it. And so I manage the relationship. And if the relationship with me and my investors, that's something I have to do. I have to manage the relationship. Bow, bow, bow. Jeremiah says, what if they bring inflation down successfully and then lower rates and inflation still rises again in a timeline of like 3 years? Jeremiah, great question. By the way, great to see you on. I remember when you were just a baby, so it's been a long time. Yeah, I think that it's possible that we kind of whiplash back and forth. That's what happened in the 80s. Inflation, kept getting out of control. The things that started inflation running wild were two things. One, the pandemic forced supply chain breakdown, effectively. Two, it's actually the other way around. Two is actually one. And two is the government printed more money than they've ever printed in the previous 50 years of stimulus spending. They spent and they stimulated a ton. They propped up the economy on printed dollars. And what happens is if you print a whole bunch of dollars and the economy doesn't grow to support those dollars, then you have inflation running wild and the value of those dollars falls relative to what it can buy. So that's what happened. The government printed itself into inflation. If they've now cut back significantly, so we should see inflation come down. Supply chains are being rebuilt and catching up, and so a lot of the things. And there was a war also. The war also strained the supply chains further. I think that once it's under control, I think it'll be okay. It's very unlikely we'll see inflation. Like there needs to be a catalyst. Like we had the war as a catalyst, we had supply chain breakdowns as a catalyst, and we also had the government printing money, like going crazy printing money. So if the government does stimulate and print a ton of money again, we could have rapid inflation again. It's possible for sure. I think it's unlikely though. We won't have those same catalysts come together again in the same way. Jason says, are there any great side hustles you pursued during school? I used to tutor. I got like a 95 in the intro to business class. And so I would meet with people at $30 an hour back in the day. I would do two sessions at once, and I would teach accounting and finance and just business overall case review. And that was a great little side hustle. I wanted to get going with like 10 students at once, because then that would be like $30 times 10, it's like $300 an hour. Never ended up making it work, but I had a few students that I tutored, just side cash. I worked full time while I went to school at the CBSA, Canada Border Services Agency, as a duty clerk, assigning basically value to people importing goods. And that was shift work. So I could work, I crammed my whole schedule into 3 days a week. And then I did 3 days a week, 12-hour shifts. So I worked 36 hours a week while going to Western full time. And then I picked up a flip when I was 19, or a first property, not a flip, my primary house, which I renovated and worked on. So I've always had side gigs where I was doing something else besides just working. I flipped cars for a while. I had a nice Mitsubishi Spider Eclipse convertible. It was a beautiful car, had bucket seats, and it's the car from Fast and Furious. So I bought one of those, didn't run, and I got it tuned up, and I traded it for a Mitsubishi Lancer, which was actually not a great trade. I got a van going. I started by trading some cards, some hockey cards for a hot tub. Then I moved the guy's hot tub, and I traded the hot tub for the vehicle. So I traded up a whole bunch of stuff. It was a show called Barter Kings that had come out in like 2011 or something. And I remember watching it thinking, it's exactly what I'm doing. Like I'm literally doing that, where you start with something small and you trade up to something big. So I did that. I traded up like a $10 item to like a $10,000 item. So that was kind of fun. And then I got into real estate, and I was like, this is way better than like flipping cards or something low value, low margin. The bigger you go, the more the margins are. So hopefully those ideas can help you. There's lots of other things I'm sure that I've done over time. I started a bunch of businesses that failed too. I had a hood and duck cleaning business that I started with a friend, and that went nowhere. That guy ended up stealing a lot of the money, cashing some of the checks, not telling me. The equipment broke down, our van broke down. That was when I was 18. I've had several businesses that failed along the way. That was because I was a kid going to school full time, and like I learned a lot. I didn't know a lot about business back then. I learned some systems and practices, and I trusted too much, to be honest. But I made some money doing it, so not as much as I could be making. But side hustles are all about just finding ways to learn at the same time as you earn. What kind of study and research do you do in a typical week? For me, it's like all Google, Instagram, people sharing, talking with me. That's most of the way that I'm learning. I have several sites that I follow and pages that I follow for good finance stuff, and I'm nothing special. You can learn the same things I do by spending a few hours a week. Handyman is a decent one. You're trading time for money, but it's decent. Yeah, you can do all those things. Good points. Drop shipping. People get some success in drop shipping. Some people lose money, but a lot of people I know have made some money at it and had some levels of success. This next one was Ash says, yeah. Going to need more information. People are all helping in the comments. I love that when people are helping each other. That's awesome. Anyway, I got to go. I'm going to wrap up the stream. I've been over an hour. I was trying to be 45 minutes, and I spent over an hour and 5 minutes. Again, it happened. Thank you so much, everyone, for watching. I really appreciate all the people who hit the like button. We got 28 likes, almost 30. I'll live with that. For the live stream, that's all we can hope for right now. If you're still watching, you haven't hit the like button, go hit the like button. It's like when someone finishes speaking and you stand there and you don't clap. It's just rude. Just give a little clap. Drop a comment, too. That'd be cool. After the stream is finished, if you just jump in there and leave anything, enjoy the stream, enjoy the video, that helps the algorithm too, so that's cool. So appreciate all the likes. There are 4 more likes just came in. I appreciate you guys. Remember, the secret to unlocking wealth through you, 3 levers. You're in control of your financial future just by tweaking these 3 levers. It's only 3 levers that we have to build wealth. It's the equation for building wealth. No matter who you are, you got to spend less than you earn, so you got to spend less. You got to find ways to earn more money, because if you're making minimum wage, it's not going to cut it. It'll help. You'll get there, but you need to find ways to earn more money. And then once you have a difference, once you've found a way to earn a lot more than you're spending, and so you're starting to save money, then it's about maximizing the returns and the difference. And that's when we can talk about what you invest into. But in the beginning, it's really just about getting that money you're making up and getting that spending you're spending down. You got to make a big gap there. Even if you're making $30,000 a year, you can find a way to live on 15. I did it. I'm proving that it's possible. I did a video several years ago about how to live well on minimum wage. There's a video I watched about a couple, both worked at McDonald's full time. They saved $1 million by the time they were 40. 20 years at McDonald's, from age 19 to age 39. They work 20 years and they're millionaires. Working at McDonald's, minimum wage. It's doable. Yeah, your lifestyle's gonna be a little bit less than ideal for a little while. You might have to live like a student in your 20s, which I did anyway, right? But that's what it is. That's what it is, guys. Is like, that's part of delaying gratification. I delayed it from when I was 17 to when I was 26, let's call it. So for that, like, 9-year point from 17 to 26, I was really frugal. I'm still frugal now, but I was really frugal then. I now enjoy a little bit. I have a lot of passive income, but I still save 80 or 90% of what I make. I make a lot now. So if I spend 100 or 200 grand, that's still an 80% savings rate. But like, again, I'm still super frugal. I'm here at this hotel, $53 a night tonight, as an example. I could afford a $300 hotel and spend more money, but then that just runs my business at a lower profitability. I want my business to have success. So when I have business expenses, I'm still trying to spend as little as I possibly humanly can. Whenever I can, I'm trying to spend as little as possible. And that's part of maximizing profit. And that's, again, the sacrifices you make now. If you can save, like tonight, I'll save $100 or $200 from what this rate would be market, maybe $250. That $200, you go invest that over the next 50 years. When I'm 80 years old, I'm 30 now, when I'm 80, that $250 every single day that I saved for a year is millions of dollars, tens of millions of dollars. So when you say, don't worry about the dollars, well, you're really saying, I don't care about millions of dollars later on. So yeah, something to think about, guys. The value of that dollar 50 years from now is like 100 times. So that's, every time you're letting dollars go, you gotta enjoy life at the same time though. Like, don't be so stingy that you're not enjoying your life, because like, life's short. Enjoy and live a good life. I gotta go though. We'll go out to that water park and see what's good. Let's go see if my kids are down there. Just gotta see. Not bad. Not bad for the price. It's crazy. Florida right now is like, see my little pony, guys? Little ponytail in. Not bad for Florida, where everything's $500 a night right now. So we're on March break season. Thanks everyone for watching. We'll see you next week. Remember, spend less, earn more, maximize returns. Bye, guys.